Meantime, crypto markets have been taking a slight hit this week after the enthusiasm on new Bitcoin ETFs has slowed down a bit.
It's Tesla, but importantly, it's not recovering quite to the same degree as some others, down 20% year to date.
So we had so much visibility. When the inflows started, it was like a head fake, and it got us so much more attention than we would have gotten otherwise. We're looking at this very carefully, the futures. There are some tax ramifications we'd like to understand more, having to do with contango, which is what contango versus more normal backwardation.
Right.
So
not yet.
Not yet. So Bitcoin specifically, we got involved when it was a $6 billion market cap, and here's Art Laffer again in my life and in Art's life. It was a $6 billion cap then. Now it's over $1 trillion, which is, but we were asking the question, this was 2015, could Bitcoin serve the three roles of money? And we came to the conclusion that it was possible. Art Laffer collaborated, he tore our original paper up, and as we were going through it, he said, this is the rules-based monetary system I've been waiting for since we left the gold exchange standard, 1971.
Right.
And I said to him, oh, how big could this be? And he said, well, how big is the US monetary base? And back then, remember, this is a $6 billion cap. Back then, it was a $4.5 trillion monetary base. Today, we're at $8.5 trillion. And Bitcoin's at $1 trillion. And that's just one of its roles, I think the most fascinating thing that's happening is in El Salvador. Have you heard? They deemed Bitcoin, the president, who tweets every day, deemed Bitcoin legal tender and sent a Chivo wallet to everyone in the population eligible, so 4 million. 3 million, it had $30 worth of Bitcoin in it. 3 million have downloaded it. Only 1.2 million in that country have a banking relationship. So this is the new bank, digital wallets, and it's going to be true in this country, it's going to be true around the world.
So all in.
All in. We are seeking the truth as these new technologies evolve, all of them at the same time,
right,
and cause like a lot of chaos, a lot of confusion, a lot of FUD, fear, uncertainty, and doubt in our markets. And we're trying to allocate capital to its highest and best use, do the right thing. And one of the reasons people thought we were going to fail is here we chose a wrapper that was dominated by passive portfolios,
right,
and put an active strategy in there. And people thought that was crazy. Now, after 2.5 years of no traction, effectively, I began to say, wow, was that a bad move? And so we started doing separately managed accounts and so forth. But it turns out that that was a great decision because so many people thought it was such an awful decision.
Right.
We had so much visibility. When the inflows started, it was like a head fake, and it got us so much more attention than we would have gotten otherwise. Too volatile. That was the pitch. I mean, that was the response. Too volatile. We couldn't possibly do that. And here we are a volatile strategy.
Right.
And our response was, well, volatility on the upside is not a bad thing.
Right.
And last year was a good example of that. The other thing we said at the time, and we actually took our cues from a value investor who said to us, I would never buy one stock in your portfolio, but I like your research and you might be right, so I'm going to just put 5%. This is a value investor, 5% as a hedge. And as did our first institutional investor, which is value-oriented,
right,
and kind of thought we were behaving like a value manager, long-term time horizon, and looking for extreme values. Well, value investors are using price to book and dividend yield and that sort of thing. We're using growth. You know, we're using spectacular growth rates that no one is expecting. And Tesla was our first proof of concept, I would say, a very visible one, where people were saying, what are they talking about? And all we had done was used Wright's Law, which is the centerpiece of our research, to try and figure out how quickly costs would decline in battery pack systems, how much prices would fall for electric vehicles, and how quickly the uptake would be. And we saw Elon Musk, magnificent things happening in terms of
But it wasn't
cost.
so easy to be invested in Tesla early on.
For us, it was easy. Tesla's battery technology is unlike any other auto manufacturer's battery technology. Tesla was riding down the cost curve of the consumer electronics industry. So laptops, cell phones, huge volumes, right? And when you get a scaling like that, costs come down. It's called a learning curve in the tech industry. So Elon, you had auto manufacturers and auto analysts laughing at him. Elon is building his car on top of cell phone batteries. Isn't that funny? Our first move away from China was when China was, had a very strong move, and the innovation there was being deeply appreciated while ours was not. So that was that kind of move. The second time we moved in, or then we moved in, why? We saw the reaction to COVID, and we got more interested because it was the most disciplined country in terms of both monetary and fiscal policy during the crisis. And I thought that China had the possibility of becoming the Germany and Switzerland of the world, in terms of discipline, monetary and fiscal. As soon as Jack Ma was banished, effectively, last November, we started pulling back. Because what we're doing, and especially during February through May, where our strategy, just to give you a sense how volatile that is, our strategy from mid-February through mid-May, most people wouldn't admit this maybe, but this is how volatile we are.
Yeah.
Transparency was down 37%, peak to trough. So we have come back, but during that period, what we do, as we always do, we concentrated our portfolio towards our highest conviction names. China was moving away because almost every week and month there was a new regulatory move or crackdown. So it was easy to do that. It was great because I'm always scrambling, looking for cash during a correction. Okay, where's the confidence lower? Now, common prosperity. So what have we done? No China in our flagship. We do own some China in a few of our portfolios, the ones focused on autonomous technology and robotics. But we're very particular. Very low margin companies, because margin is clearly not appreciated by the government anymore. Common prosperity.
Right.
There are the haves and the have-nots in China, like there is around the world. I think China's taking it more seriously because there's probably more social unrest than we now appreciate. What I don't understand is they're going after real estate, which is 75% of the consumer savings in China.
Individuals in China.
And if yes, individual saving. If the prices are going down, which they have been, I think that could really hurt consumer confidence. I think it already is. And then last weekend, or the weekend before, the national government went after the regulators who had focused on the financial industry as well as the financial institutions. And I'm just saying, wow, they're playing with fire.
It's a moving, yeah.
And talk about a cyclical risk out there. Think about that if we lose China. At the margin, China has been responsible for a tremendous amount of cyclical growth.